Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
All right, guys. I probably should have started this a couple of minutes ago, but here we go. We got 15 seconds. I'm putting a little, I told you so gamble on here on a sim account. Let's see what happens here. It may, I don't know, the initial release here may not be a huge deal. Oh, looks like they're selling, at least initially. Okay. So it went both ways here. The first reaction was down, though. I'm kind of prone to trust the first reaction more. After price says time for my nap. How can you sleep with this kind of action? Actually, I can totally see it. Someday, as I become a household name and a celebrity and all that sort of thing, and they'll invite me to go to the Federal Reserve press conference so that I myself can ask Jerome Powell a question. And, I'll get my chance. They'll ask me the question, or, I'll ask him the question. It'll be an amazing question. And then I'll spend the rest of the meeting trying to not fall asleep. That's what would happen, probably. I think so. Okay, S&P seems to be liking it, but the treasuries also kind of seem to be liking it. Economic activity continues to expand at a solid pace. Job gains have remained strong. Unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. The Fed will slow the decline of the balance sheet by cutting Treasury redemption cap to $25 billion per month from $60 billion starting June the 1st. That is probably the most important thing. That tapering may be why the Treasuries are trading up. Let's see here. Do I see a change in the yield curve? Maybe a little bit of steepening, which would coincide with us moving up. So I think that this trade is looking good so far. Where shall we take our first profits? Well, let's if they could get to like past 108 even, that would be a good spot to take one contract off. Yeah, they're busting highs. Let's go. Love to get some more out of that before he starts talking, because once he starts talking, sometimes it kind of gets a little hot. Okay, Joseph Boeing says, dovish surprise for quantitative tightening. The cap is down from 60 billion to 25 billion. I believe the expectation was 30 billion. Was the expectation 30 billion? Okay, well. By the way, did you guys check me on the Ninja Trader channel? Because I said this, I was like, I wouldn't take a bet on this because there's all sorts of other crazy stuff going on, but I kind of think that the treasuries are going to be higher. Well, there's still the press conference. Powell could like totally ruin everything for me, right? But right now, feeling pretty smart. Feeling pretty smart. I'm a little bit like low energy, I feel, for some reason. I don't know. I don't know why, what the deal is. Didn't sleep very well. The dogs, for some reason, kept waking up in the middle of the night. So maybe that's why I'm a little bit lower energy than I feel like I should. But feeling pretty smart right now. It was the gosh dang it, Jake. Why did you have to remind me? I forgot about that, and now you brought it back up again. When it got out, my wife, when it was done with the stream, my wife was making lunch, and she was having eggs, and I was like, "Wait, where did you get eggs from?" That I thought that I was eating like the last ones, but apparently the chickens have been busy. I could have had a poop covered egg instead. That would have been way more healthy. That last little push there was pretty encouraging. The liquidity, though, is still scary. Like, you've got to have a big stop to trade this. See, the Fed game that we got going on here, it's like the opposite. You ever heard the whole thing about like your foreign policy should be like speak softly and carry a big stick, right? This is the opposite. This is like speak really, really loudly and carry a feather around with you or something like that. You know what? I don't think that was a very good analogy. I'm sure somebody could come up with something more clever than myself, but I'm just saying. They kind of like talking a big game, and then it's like, oh, but we are going to taper, yeah. There was a little bit more change in the statement than I expected, but I don't see anything too big. I think the only thing so far that really, really matters is the taper. Taper coming in June, and it's going to be 25 billion. What's going on? Old gold taking a big jump. The Japanese yen taking a big jump. Bitcoin kind of starting to get something going. Treasuries in the retracement right now weren't really able to hold those prices for very long. Does look like it's calming down at 24.5. We still need some more liquidity to come in here. You know, I would like to see those bids start getting firm, like somebody else come in and all of a sudden every time we tick up there's 5,000 under there. That's the sort of thing that I could foresee happening in this situation if big guys come in and say, oh yeah, this really matters and it's gonna push treasuries up over in the midterm. Could do. I wonder if I should have, instead of placing my take profit at 108, even if I should have put it at $500, then I'd already be out with one order and I could be taking it a second time. Well, that's okay. It doesn't matter. I guess it doesn't really matter. I think that the dollar is kind of part of the movement here too. The dollar seems to be reverting a little bit. Nope, it still kind of looks like they're just being flaky in this area. I don't know if they could really build a really good run here. But we got 20 minutes until the press conference, so. Oh, look, here's somebody on Reddit. I'm trading the 10-year US bond, and I'm wondering if anyone has experience with this market. Don't anybody tell him. Oh, you're like, oh yeah, you should go to Speculator. That's what he does. Speculator Seth, check out his YouTube channel. That'd be a great place. It's Reddit. Don't tell the people on Reddit. Wait, did anybody? Let's see if anybody mentions my name in here. Nope, nobody's mentioned me. Okay. I think we're safe. I think our secret's safe. See, what do they say? Oh, here's somebody that said that they traded calendar spreads. That sounds interesting. And that guy sounds like, oh, let's see if he says anything interesting in his post history. Yes, it's a 10-year note. He's got, good. Put the noob in his place by making a really pedantic distinction between two things. That's the way to do it. We're gatekeeping this up in here. What's this? Notes and bonds are difficult to trade. Okay, it would be a treasure. Okay, I don't know if that's true, but the micro contract is fun to trade. All this guy's got is like stuff about Yu-Gi-Oh! What the heck? Yeah, okay, whatever. It is what we should do is we should send them to the Discord. There we go. We set them on the path without mentioning my name. That's the way to do it. Okay. Now, meanwhile, over here. a little softer here than I would like to see, but yeah, we're still holding the 24-ish area. And dollar kind of being a little bit, like you always tend to see this sort of a thing, like the Z or whatever we want to call it. Okay, where it goes from here is probably a little bit more difficult to tell. Like usually you get a pullback, but where from here? And the 10-year, it looks like they're kind of having like, they've kind of burned up all of their fuel already in terms of like stops and that sort of a thing. So we're really going to need more market orders to come through here, maybe. So we might be stuck here until Powell, I'm thinking. What the heck? Okay, from r/CS career questions. Well, while we're waiting for the Federal Reserve meeting, let's read Reddit because, it's such a wonderful website. Hate that website. I mean, I don't ever read Reddit, but somebody sent this to me. Okay, what happens to older software engineers and other careers? The more experienced you get, the more your value and command over your work increases. But in software, things change so fast that you never really get to, quote, expert level and always need to keep learning new things. So how long do people usually keep this going? And does upskilling get challenging with age? I've rarely ever worked with engineers who were in their 50s or above, and the few I have worked with seemed like they did struggle. Is this a career for the young and not something you should plan to do for the rest of your life? Question mark. The first response, the Rabid Monkey says, my lead just turned 50. I hugged him and told him I appreciated all the things that he's done for me. Then I told him to look out towards the sunset. With one tear streaming down my cheek, I fired. It's over. No more coding for you. No more REST rest. It's time to rest. Gosh. He's doing code reviews in Jira Heaven now. No, there is no Jira in heaven. Is there? Maybe there is Jira in heaven. Oh my gosh, I have to think about this for a second. Is there a Jira under Mormon standard doctrine? Would there be a Jira in heaven? I would kind of hope that celestial beings would have like photographic memory and would therefore not need to have all of these systems to record things and so forth. But maybe there's a piece of technology that just kind of does it all automatically. So maybe there is a Jira in heaven, but it's just like it's heavenly Jira. So it's very different from the Jira that we know. think so. I think I'm going to go with that answer. What? At my first job in 2006, there was an older software engineer, probably the oldest of us, who still had to look down at his keyboard and actively search for specific characters using only his pointer fingers. I thought, man, is this what it's going to look like if I'm planning to be a software engineer all the way through retirement? Obviously, he's going to retire soon. His hair is gray. Is this what dying looks like? Man. But what a lot of young new devs don't understand is every company has legacy. New tech is adopted at a snail's pace, and phasing out legacy takes forever. And guess what? New grads, juniors get to work on to help get a feel of how things work. I've seen a lot of posts here from young devs tired of this old code that they're forced to work in, thinking that going to Fang is going to solve that problem. I can only imagine the kind of legacy code that they have over at Google. Okay, there is less urgency for an org to keep up with the pace that the technology is moving outside of the office. No one is going to be an expert, but the older devs have the expertise, despite what it seems. They could be very well keeping up. And there's a project to migrate to the hot framework, but in the real world, the project is going to take so much planning, design, and most important of all, buy-in from the C-suite that this is going to be worth the investment. By the time you're working on the migration, the version you're implementing is already previous. I used to go crazy in my younger day thinking, why is there so much resistance from the older engineers to upgrade to the latest version of jQuery? Why are we on this crappy Cold Fusion CMS one? Oh, well, okay. If you were on Cold Fusion, my friend, that was legitimate. You know, why are we staying on this? Yeah, that was a legitimate question. That you should have just quit. You should have just quit. Anyways. What do you mean I need to make sure this library still works in IE6? Now I just turned 40. I had a phase of being behind in general, but that wasn't due to a deteriorating brain. I was young and I thought I was the stuff, and there wasn't anyone really around me at work to tell me what I wasn't doing right now. I feel pretty rejuvenated, and I'm actually stoked for what lies ahead in the rest of my career. The only other time I felt this excited about upskilling was when I first got into the industry. The only difference now is I have to take meds. Oh, okay. Okay, back to 25. They're getting a little bit of it came back there really quick, so we're getting a little bit of a pickup again. I'm not necessarily seeing the volume with it though, so still, it makes my trade look awfully good. It's 8 ticks. Usually it's hard for me to get more than 10 ticks, so. Can I use ATM strategies in the strategy builder? I actually I don't think you can. So you can create these in code, but it's a little sometimes it's a little complicated. When you get into like order handling, that kind of becomes more advanced stuff. There's some things where like when you really have to do like the complete order handling yourself, that I kind of start to be like, maybe you don't want to mess with that. But what is it that you're actually like? What is the specific ATM strategy that you want to do? Because if you're just trying to set like a set, stop, and target, that's really simple. You just do set top profit target, and then profit target mode dot ticks, and then number of ticks that you want. Kind of a weird little jump there. But I mean, the dollar did drop there, so. Oh, yes. You're trying to reverse double at stop loss? That was okay, I did that on a stream. I could actually send it to you if you like messaged me on the Discord. I would go and find it. But when you do that, yeah, when the kind of like the typical way that they describe to do it, will cheat the backtester. Like the backtester will say, oh, okay, so you took the reverse of this trade now here at this point, and this is what price you would have gotten everything, and the price that it's giving you is total BS. So what you have to do is like set a flag and say, I just hit my stop loss, and then tell it to immediately get in on the start of the next bar. So once it's like the start of the next bar, and you back test it, and well, when I did it, there was no edge in it, but they said the same about a backtest. Well, some people online are just kind of like anti all backtests. But really what that just comes down to is that like you have to know what you're doing to some extent, right? Like there's experience with it, and you're more likely to find a way to cheat the backtester than you are to find an actual edge. It's a lot easier to find the weaknesses in the backtester. So, and that's one of them, is that if you're doing anything with order management. So let me explain it to you like much more specifically, okay? There's a method called on bar update. And that's where we come in and we say, okay, this is the end of the bar, start of the next bar. And I do all of my calculations and decide if I want to get in or out or not, right? It runs every bar. So the possible price that I can get should basically be like the open of the next bar, right? Okay. Well, there's another method, a group of methods that can be like on position update, or is there an on account update? I don't recall. Order update, on position or on order update. They will basically say, okay, when an order updates, basically an order gets filled, and then you can look at it and you can say, oh, well, if it was my stop order, then submit another market order to open a position the other way. Okay. So when that piece of code executes is not when the on bar update updates. It happens inside of that bar, right? And the thing is that the system doesn't know what the price was like halfway through that bar. They just know the open, low, high, close, right? And so what it does is it just assumes that you got the open when it's too late. You wouldn't have gotten that anymore. Get what I'm saying, right? So it's a way of cheating the backtester. So the way that I fixed that was I said, okay, I'm just going to set a flag and I'm going to get in on the next bar. You get in on the next bar, then you see it. And when you do that, because if you do the back test with the cheating way, it's like, oh my gosh, this is amazing. Why am I making so much money on the reversal trade? Right? But then once you fix it, then there's no edge in it. So there's a couple of people out there running around saying like, oh, if you just reverse your trades, like those work amazing, and because they haven't realized that they were cheating the backtester. So just just do like, okay, if the order was a stop, then set just stopped out equal to true. And then inside of your on bar close, say if my stop out Boolean is true, then I take the reversal and then reset the variable. It's time for the meeting. We need to pull it up. Okay, he's coming out.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
Okay.
The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective.
It's funny that they're moving up and down
Inflation risks.
based on every little word he
More to say
says.
about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last
Try
year to
taking
1.6%
really good
in the
notes.
first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7%
Okay.
over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.1%. The inflation data received so far this year have been higher than expected.
Come on.
Although some measures of short-term inflation expectations have increased in recent months,
Fine.
longer-term inflation expectations appear to remain well anchored
Never get to have any fun anymore.
Range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials
hit it.
like food,
It's
housing.
only 3,700 contracts. You've got that much size.
To returning inflation to our 2%.
Show the market what you got.
The committee
Show them how much
decided
firepower
to
you have.
maintain the
Just
target
hit
range
that.
of the federal funds rate
Just,
at
four-
5
just
1/4
4,000 contracts. Be easy.
and
Just
to
blow
continue
through
the
it.
process of significantly reducing our securities holdings, though at a slower pace.
I don't think I'm convincing him.
Last year, as labor market tightness has eased,
Anybody. Nobody's biting.
the
Nobody's
risks to
biting.
achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%.
Ah.
So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will
We'll see how this goes, but I feel like that comment that he just put in there was probably the most hawkish that he's going to get.
that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal. and
Right back to that big order at 28.
well.
They gonna hit it this time?
Restoring price stability is essential to set the stage for achieving maximum employment and stable prices.
Wait, that's a 160.
To conclude, we understand that our actions affect communities, families, and businesses across the
Stop
country.
being so shy.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look
Ah, that's it. That's what I like to see. 3 ticks up, all at once. 3,400 traded at 28.
If I could, do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know.
I'm going to put down everything that he said, but I'm going to try and keep track of all the questions that they ask.
And the JOLTS report. That's demand cooling. The same is true of quits.
New highs,
Which is essentially normalized.
Ooh, some of those limit orders are pulling.
Pardon me. Surveys of workers and businesses and ask workers, are jobs plentiful? And ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
You said it is restrictive.
That we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored.
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina.
Okay. Gina.
Thanks for taking our questions, Chair Powell. I wonder, you know, obviously Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move.
It's like I got filled.
Unlikely. You know, our policy focus is really what.
You know what we do now, right? You just
which
let
is
it.
how long to keep
let it
policy restrictive. You ask, what would it take? You know, I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality.
That's not really helpful at all.
Inflation expectations, and all the other data too.
How would I know that policy is not sufficiently restrictive?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the.
I didn't catch that guy's name.
How the outlook is evolving and the balance of risks, as always, and we'll look at the totality.
Not as cool as Gina.
So I think.
So I don't have to put your name down. Sorry.
Position to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, you know, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that you mentioned that it would be inflation persistent. I mean, is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
I have another really big order at 06.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic.
Curious. He says don't target the labor market.
Distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter. And I've said,
getting good at redirecting the questions and stuff.
It's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in-housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to
look at the Treasury market, doofus.
The economy. It really is to
which one do you think matters more to them right now?
Down to where we want to get it is a smooth.
He's not a doofus. I shouldn't call him doofus. I really respect Powell. I think he's been a pretty good chairman, despite the mistakes here and everything. But I really like the guy.
Torres from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree. It's, nobody likes it, but
is there a question?
For being patient and working with the economic cycle to get it down over time. Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably on at 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It actually, it's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it. And that's how we think about that.
I really liked that question, but I kind of feel like he cut it short there because, we're not really seeing employment hurt that bad yet, are we? Well, like, jobs numbers don't say that employment sucks. But it is interesting to know, like, what is the reaction function? When does employment matter more than inflation? That's interesting.
Rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the U.S. economy. Do you or anyone else?
I think that the reason the market is taking off is primarily because of the reduction in the quantitative easing
that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence.
I didn't hear her whole question.
I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained.
This is a good point right here.
And would come down, but that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation actually.
Okay. I buy that. That was a very good answer there.
From Bloomberg Radio and Television, the vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023, and we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly. both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year for that matter too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got, you've got more supply, but those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point, you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive. And, you know, our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And, you know, are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time. And we think our policy stance is appropriate to do that.
Yep,
So
that's my.
if we were to conclude
This is where I think I take my profits on this one because I don't know where it's going to go from here.
inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates.
That was a really good trade.
We don't see evidence for that.
I haven't had one of those play out that well in a long time.
So the policy focus has really been on what to do about holding the current level of restriction. That's
You
really
see how ADHD I am? I totally missed this question.
I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. You know, these are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Imagine having the money to be able to send questions to somebody in this room right now to ask Powell something.
Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between, starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of
Nobody believes you except for me. I believe you. I believe you, Jay Powell.
we'd actually get the economics.
I think that you'll do what you got to do, no matter what the election is going to be.
We know that.
But I don't think anybody else believes you.
When we think it's the right thing, and we'll all do that, and that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making
I love it.
decisions based on
That right there, folks, is integrity
and the balance of risks.
He believes that. He does believe that.
Is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is.
Okay.
We just don't do that. I mean, you can go back and read the transcripts for every. This is my fourth presidential election here. Read all the
Really?
and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Okay.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat.
He survived 2 presidents. He must have some skill.
Roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there.
Thinking about the whole thing about, do you factor in the election and all of that?
If that's the case, so
part of that, I think, is that he is going to hold interest rates steady until after the election, and he's miffed that anybody thinks that it's because of the election and not because of the economic conditions. I feel his pain. That would be really annoying to me. That I feel like I'm doing the right thing, and the market all thinks it's because of the election.
Consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, I did not get what that question was. I was like paying attention and heard the words, but I didn't hear the question.
In the lower income brackets is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life, go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at. Anyway, headline peaked at 7.1, now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually, working alongside and with the healing of the supply side. That was different this time.
Ali kind of in Discord, he was like, it looks like the ride is over, and I was kind of feeling that way too, so I felt like it kind of gave me enough confidence to call it. And man, that was a good call. He called
this was to do with
pretty much the top.
Shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market.
Didn't he kind of say that we're expecting to get more inflation from housing costs coming through, though? I think she understood him the opposite of what he said.
They were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets, at least, have been on
I don't know how you spell that name.
Trajectory.
Is that a Jewish name?
Easing during the pandemic,
Jasinski?
fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So
good question, my friend.
That may happen, and you know that we all serve domestic mandates, right?
They didn't let us see them.
Between the United States and
got a good question.
that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition, for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation, and so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy?
I don't know if yellow is your color, Jen.
Softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get.
I was so distracted by her yellow shirt that I didn't even hear her question.
That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can.
We will.
Without
I like it.
dislocations in the
I
labor
like it.
market.
Don't just say we're committed to it. Say we're going to make it happen one way or another.
In terms of cutting, you said
My boy.
if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but, it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
I'm glad you went to the gym. Really? I took that trade. I loved it. It was a great one.
You've said that broad and material changes.
You missed one of my greatest moments, Octavius. I'm a little hurt.
You mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me
what are we talking about?
The Fed is committed to, completing this process and carrying out Basel III Endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist.
I went long.
And then do you need to resolve?
I think they're almost done here, and I can explain what we did.
In order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking. or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group of branded people. Frankly, more diverse than it used to be in many dimensions. More diverse from the obvious, gender and demographic ways, but also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question. Thank you very much.
Well, that ended up being like a really good, interesting question for us. Trying to understand how the Federal Reserve works internally and everything is a really important and useful thing. And so a question like that kind of gives you a little bit of color about how things work on the inside that I think is really, can really be insightful for us. Okay, so what was my trade? Basically, I came in here and I said, I think that the bar is too high, that Powell will not be able to be hawkish enough to slam the market down. So the market is likely to read whatever he's saying as dovishly anyways. And then the bigger thing, though, was that I was kind of betting that the combination of the Treasury refunding announcements and the expected taper that we were supposed to get in this meeting would be a boon to the treasuries, and it was. And so, of course, what happens on a Federal Reserve Day is people, there's a lot of traders kind of trying to watch this and figure out what the knee-jerk reaction is from that, and then determine if it's going to continue higher and whatnot. So I decided that I would just take a gamble with the sim trade. So it was a sim trade. I didn't make any real money on it, of course. I wouldn't risk my money on a Federal Reserve meeting like that because it can just be so super crazy, right? But I entered in the trade before the statement release, and I took 2 contracts. I took one contract off at 108 even. And I took the other one off somewhere around, let's see here, what was it? Orders 108.25. So right here. So it was a pretty good call. I kind of was able to get a good feel and get some confluence of a couple of things to give me the confidence to take it off there. I'm really, really happy with that trade. And yeah. So I do think though that so I was on Ninja Trader's live stream this morning. After our stream, I went to Ninja Trader. If you didn't check that out, you should go and watch it. They told me that like most of their viewers watch it after the fact. So I'm gonna be on there again on Friday. When I'm on there on Friday, you guys all got to go over there and like light up their chat because their chat's a little bit quiet. And I feel like I kind of need a little bit of back and forth with the chat, you know what I mean? But I digress. On there, I straight up said, if you were going to hold my feet to the fire and make me take a trade, I would go long the treasuries. So I decided, hey, let's put a sim order in so that we can say, what would have happened. I can't just say, oh, I was right. Like, how would I have managed the trade too? And it turns out that I would have, it was amazing. That was one of the best in terms of execution and the plan all working out and everything. That was one of the best I've ever done. So really happy with that. But that was not the point. The point was, I kind of think that it really has more to do with kind of those passive flows and the market realizing what's going to be happening with the liquidity in the market and with the auctions and so forth, and seeing that being a slight, decline to rates, a little bit of a boon to treasury prices, and then just a bunch of other people jumping on board it, a little bit of momentum coming through. And so if that's the case, yeah, we're going to have some pullbacks. We're going to have some mean reversion. Who knows what it does tomorrow? And of course, there's Friday. Friday is going to be just probably bonkers. But over the larger time frame, I kind of think that we're going to be in another one of those situations similar to what we had through most of the through most of the first quarter of this year, where, there's a little bit of gentle upward pressure because of what the Treasury and the Federal Reserve are doing with, the other parts of their monetary policy tool. So that's why I said one of the things that he commented about was, well, we don't really think about, what is the effect that this is going to have on rates or whatever, because our primary tool is the interest rate. And I'd say, well, but that stuff has a huge impact on it because you're directly affecting orders, and orders has a strong impact on markets. So I think that it matters. I don't think that you should discount it. And I think that you do kind of have to think about and consider how much money you're taking off and how that's going to affect things, and if that perhaps makes monetary conditions too easy. Because I think that was a big major factor behind why monetary conditions got easier in the first quarter of the year. So that doesn't necessarily mean like buy treasuries hands over fists. I'd say it's just a gentle but strong. You get what I'm saying? Like Daddy Powell, he's just going to be gentle but strong with the markets here, and you're just along for the ride, right? Make of that what you will. My coworkers are yapping about something that we did yesterday. But I don't have any comments on it, so I'm going to ignore them. No. But it is time for me to get going. I'm not going to stay until the market closes. So, have fun with it tomorrow. Because we got, we got initial jobless claims tomorrow too. So, yeah, still plenty. And then next week we got CPI. So, stick around, folks. There's plenty more fun left in this month, and I'm pretty happy with today. I don't know, there's around lunch, kind of lost some energy, but then I had lunch and I'm feeling pretty good right now. I got some things to do. I'm going to go and get them done. See you tomorrow. Stay excellent.